Hello, and welcome to the Invest with Carl podcast. I'm Jamie Uppenberg, your host and a member of the Carl team. Today, we're talking with Ferdinand Ruaño from the Pentas Real Estate Fund, Pentas standing for Private Equity Non-Traditional Alternative Solution. So we're in real estate today. We'll ask the usual first questions about this fund, what makes it so successful, some fund history, and what's important for investors to know if you are looking to invest. We are Carl, digitally offering unique fund investment opportunities with packaged and data-driven delivery to accredited investors. Pentas is an upcoming investment opportunity available at Carl. Ferdinand, who's with us today, is a distinguished chief executive officer, financier, real estate developer, and investor with an extensive career spanning over 4 decades. He is associated with several prominent firms, including Private Equity Solutions, Panoramic Fund, FRA Services, and of course, Pentas. In 1981, Mr. Ruaño began his career as a broker, eventually establishing his own investment firm in 1995. He has many notable activities over the course of his career, but we will mention that he helped secure Nelson Mandela government by raising capital during South Africa's apartheid transition from 1992 to 1994. So Ferdinand has really been around. He's been doing this a long time, and we welcome him today to the show. Hi, Ferdinand. Thanks so much for joining us.
Thank you, Jamie, for having me.
So, of course, we always start with, to kick us off, tell us what has made Pentas, the Pentas strategy so successful, and why you would keep it in your portfolio.
I think, Jamie, that the most important thing about the idea of Pentas, it has evolved in different type of structures and investments. The most important idea that Pentas has is to have consistent returns, low risk, and a preservation of capital using multi strategies in the real estate world. We have come from distressed markets. We have come from the stage where the market recovered, and you have to apply different styles of real estate investing. And that's the secret sauce. I think that to adapt to the change, embrace the change, and really apply a strategy that can really enhance returns. And that's how we got the statistics of this fund. If you look by risk-adjusted basis, they are right there in the top percentile. Remember that real estate by itself as an asset, and especially if it's housing, you are going to have consistent returns, because if you look the last 48 years, even with the crisis of 2008, you made money. You made around 5% steady, very low volatile, with a standard deviation lower than 5, pretty much like an investment grade bond, pretty much. So Pentas, what they try to do is to collect the best strategies of real estate, adapted in different scenarios. Like right now, like people are talking about stagflation, they're talking about a possible recession, which I have a white paper talking about the different things and how the housing market behaves. And what we did is that we tried to do it in a way that is easier, it's pro-client, and give them a very good and decent return. For example, this fund has an 8% annual preferred return and 70% profit sharing. So when you have the track record, which is it is available in our transactions before we launch this fund, you will see a consistent pattern of high risk-adjusted returns. And that's what really makes, and that's why I am pleased to be invited to join the Carl funds.
So obviously, a strong return for this fund, for this investment fund. When you talk about it has, you've taken kind of the best of the real estate investing. What does that really mean? What is it? What are we really investing in?
Basically, you're investing in build to rent, build to sell, in single family homes that we develop or we acquire And pretty much Pentas became a big developer here in Florida, creating single-family homes, developing single-family homes. When you manufacture and you build homes, you have this uncanny ability of not controlling markets, but you can set the market and you can probably control some of the supply and demand issues of building cost to build, and probably the selling price too, if your product is unique. So you as a builder, as a developer, you can create the market, you can set the standard of the market. And that is something that not a lot of investors can do. And that's usually part of the strategies that we do. For example, in 2010 to 2012, Jamie, we really invest in, when you look at our track record, you're going to see a lot of flips. We bought foreclosures. We bought tax liens. That is an investment that not a lot of people, they think that is easy, but tax liens are not easy. You have to really get into the legal jargon and understand how it works. So when you look at the 2013, 2015 market, that's when the Jobs Act of Obama came in, and basically you can see a recovery. We have to adjust from the foreclosure and distressed market strategies into a recovery market strategy. And what is that?
Right.
Buy fix and offer, buy probably REOs, which is real estate owned properties, not necessarily buy cheap, but probably 75 cents in the dollar, rent it for a little bit, lease to own some of it, and then you sell it when you get the full recovery. So those are things that you learn. And that's what usually the unique power of adaptability, multi-strategy that you can have. And now, since 2000, I would say 2016, 17, multifamily, building new homes. There is a scarcity of new homes. You know that. There is a deficit of 4.5 million units of affordable housing right now. That's why rents are so high. And even in COVID, the prices didn't drop. So,
well, what would you say about folks who are nervous about the interest rate environment, and interest rates are so high, yes. People aren't interested in buying homes? Like there's a lot of cooling on real estate, at least in investment talk. So what would your response be to those?
That is a fantastic question, Jamie. I believe that if you look history for the last 6 recessions, including stagflation from 1973, 1975, you will see that you can have a drop, except the 2008, which was basically caused because the recession of 2000 to 2001, 2002, housing prices didn't go down. They went up. And it created this huge amount of bubble that exploded in 2008 with the subprime mortgage. We're not in 2008. There is no way. I mean, these histories and YouTubers that I see, listen, in 2008, you don't have the underwriting guidelines, restrictions that you have right now, that they're debt to income. The Dodd-Frank made, I know it was criticized, but remember that when you have deregulation, like you have it, that you can have all kinds of loans. If you have a heartbeat, I can lend you 95% of the loan to value. Right. You are getting in trouble. Then Dodd-Frank did the opposite. Now it's going to be really restringent. Right now, we're in a happy medium that if you have income, if you have the down payment, if you have good credit, you can get the financing on it. But going to your question, I believe 3 things are very different this time. Number 1, in the last 6 recessions, the average price dropped 6% from the top. 6 to 7%.
Yep.
If you exclude 2008, which was because it was a bubble.
It was a burst. Yeah,
It just burst. Look at how the price now, before, even if you bought, you had the wrong timing and buying in the top of the 2006 market. You still will make money today. If you hold, real estate is not a timing game. It's a time game. And the idea of the situation today that you have supply, that you have 4.5 million less units in the 2008 market, you have a lot of supply.
Right. Exactly. Yeah.
If you look the consumer, if you look the unemployment rate, if you look the economy, if you look income versus debt, the incomes and debts are in much better shape. The consumer has a better balance sheet today than they had in 2008. So I think it's a matter of our secret sauce, I think, is making affordable your forever home. And we have programs like we got creative financing, we got lease to own models that we apply the rent to buy your home in 2 years. So those things, it's making the flexibility of creating financing and creating different models that can really move the inventory. And quite honestly, that's pretty much, as a developer, the fact that we can create the inventory, but at the same time, we can finance the inventory and we can create solutions for that home buyer that he wants to buy, to be honest. What happened is that with COVID, it was another distortion, because you have a huge amount of liquidity. And remember one thing, you got mortgages at 3%. So those people trust me, that they're not going to sell that home. They were going to improve the home and they're going to stick there. I mean, they're sitting in a bunch of equity. In 2008, you have deficits. It means that your equity was lower than the mortgage that they financed. That's not the case today. The case today is that you have a positive equity, good balance sheet. The consumer is in good shape. But yes, prices right now, the affordability is the lowest in the last 40 years. So one thing that I have noticed is that every time that there is a talk that interest rates are going to come down, my showings exploded. People, the people want to buy. It's just the fact that with interest rates that they came too low, and now they're not too high. To be honest, this is the average. But people, they were so spoiled with the 3%, 4%.
I agree. Yeah, I agree with you. It was really unusually low, and so now we're calling something high that those of us who have been around a little while are like, this is a fine place to buy. You'll be okay.
I think that the housing market itself, well, that's why I believe that you got to be flexible in the strategy depending on the real estate economic cycle that you are. And I think that that's part of the sauce, or the part of the strategy that makes it very comparable with a good track record. 85% of our buys and sales, they have been profitable.
Yeah. So obviously your fund itself is a good diversification, right? You have to pay attention to a completely different market than stocks and bonds, really. And they're counting on you as a fund manager to pay attention to that market, and you have experience there. So that's, that's good. So everyone, regardless of the market that we're watching, you're watching the real estate market, they're worried about what's happening in the global economy today. The politics involved right now are making things very chaotic and unsteady. How do you respond to that? How do you think that's going to impact your fund if you really don't know exactly what's going to happen next in the next month, 2 months, 6 months? What would be your answer to a nervous investor?
I will say that we have to face reality. You are absolutely right. This fund is not to put all the eggs in one basket. This is probably a diversified portfolio that you combine traditional with non-traditional, just like the endowments, just like Harvard, just like Yale endowment invested. Usually they have different access to different markets that they don't have any correlation or very low correlation with your traditional investments, stocks, bonds, ETFs, that kind of thing. So that's the first point I want to make. The second is that you have to embrace for volatility. This is going to be a volatile year, because if you look at it, this administration, Trump 2.0, I call it, they are changing the whole system. The whole system, like the global economy, like we had it before, they want to change that. They want to change the whole thing. And that is one of the things that is happening, that in uncertainty and volatility, you need assets that they are not correlated with the market, but they can have a steady income if inflation comes. For example, real estate provides you Cash flow provides you inflation hedge because you can rent and the rent goes up, they don't go down. And then you have a tangible asset that is not depending on the financial system itself. But the investor has to understand tariffs are going to have an impact. We already have the first quarter negative. You know, Jamie, that 2 quarters of negative GDP growth. Welcome to the recession. You are there. If it's short,
no, I know.
Okay. But these are things that's why the strategies, people need to live. They need a place to live. They need the shelter. Either they rent it or they buy. And we manufacture that need.
Yeah, it's interesting that you kind of, as a developer, you're like, we can build the home and sell it, or we can rent it. I haven't really heard developers be so nonchalant about changing strategy, but you're like, it's, the market turns one way, you do one. Have you had any challenges moving through that process and thinking you're going to sell these homes, but now you're going to be renting them? Like, has that proved difficult or?
Well, usually what happens is that one of the ways is that our own financing and the fact that in COVID, I don't depend in the lending or the banks. Banks were shutting down line of credit because they were concerned. They didn't know what the heck is going to happen. The vaccine takes 2 years. Let me shut down all this. Let's see what happens. And when the stimulus comes, then I would start lending again, but you're stuck. We didn't have that situation because we have different structures and different fronts like private equity, like our own private equity solutions. We got another Act 60 in Puerto Rico that get money and invested. So we didn't depend on those lines of credit. So that allow us internally to have flexibility to move inventory and say, okay, we can hang in there. Just wait, write it out, get cash flow, explain to the investors, then instead of a bank, that they don't have that patience.
I understand. Okay. Well, it's good to have that flexibility. And I think it really opens you up to more different types of markets, right? So that there's not the fear of, we're going to have all this inventory and it's going to be sitting, basically sucking cash, right? Instead of providing cash. So very, very interesting. So we're reaching the end of our chat today. So are there any final words for an investor thinking about Pentas?
I think Pentas will be a great alternative in the sense that it will give diversification of a non-traditional asset like the Warren Buffetts of the world do. Even they say and talk about stocks only. They buy a lot of build-to-rent homes by Berkshire Hathaway. I got an article a few years ago that say, in one article in 2008, I say, if I had a lot of money, I didn't have it started in stocks, I will buy all the build-to-rents that I can. And that was 2008, Warren Buffett. So
right.
What I will say is that this will be a great diversification, steady. If you look the risk adjusted, I'm not going to get into that because really we got omega ratios, Sortino ratios. So those are technical words, but what they're talking is about volatility, downside volatility, and risk adjusted returns, what they call alpha. If you want good alpha, diversified, you want to use it as an endowment, you want to invest like Yale, they usually look at this as 15, 20% out of their EDS, out of their cash, and they can get some cash flow. So that's what I would really strongly recommend to take a look at it.
Sounds great. Thank you, Ferdinand. Thank you so much for chatting today. Really nice talking with you. Our listeners, thank you so much for being with us, and we will see you next time.
Thank you.
Bye now.
Bye-bye.
Thank you for listening to the Invest with Carl podcast. The views shared on this podcast do not necessarily reflect the views of Carl. This podcast is intended for informational purposes only and is not intended to constitute and should not be deemed to be an offer to sell or a solicitation of an offer to buy any security or investment, financial advisory, legal, tax, accounting, or other professional advice. Carl funds are currently available to accredited investors with a minimum investment of $20,000. To learn more about Carl and to download the Carl app, go to investwithcarl.com.